Hi everybody, this is James Tompkins and I am now in the final lecture of this corporate finance series, lecture 6, in which I talk about the discount rate for the asset investment decision. Sometimes in textbooks they talk about the weighted average cost of capital with this heading, which is part of it. In any case, what I'm going to do is I'm going to start off the way I usually start, and that is, of course, an agenda. And I'd like to begin with why I'm doing what I'm doing, even though it's pretty thoroughly explained in Lecture 1, but I just kind of like to remind people why we're doing this particular topic. And then really, before I can get into the rest of the agenda, I need to give you a definition of what's called perfect markets. So let me get into the order of what we've done. So first of all, do you recall what the primary decision is that I'm trying to get across the financial principles for in this class? Basically, the asset investment decision. Okay, the theory and practice of the asset investment decision. What's an example of an asset investment decision? How about Boeing investing in the Dreamliner? Yep, that would count. How about Ford hiring a new CEO? Yeah, that would count. I mean, basically, it's what a company spends their money on, as you can see right there with the assets. So even though you wouldn't see, Ford's CEO right there from an accounting perspective, from a finance perspective, does that have an impact on value? It does, right? And so speaking of value, we're making decisions that impact firm value, and so we began with a model for measuring value. And as we saw in the time value of money model, what two things did you need to measure anything? Well, you can see it right there, basically cash flows and a discount rate. So then we moved to the left-hand side of the balance sheet, and we looked at the asset investment decision, and what was some bottom line analysis that we conducted that would say, hey, if this is true, this is value creating, at least with respect to what you quantify in the analysis. And that was net present value, right? And what two things did you need for net present value? Cash flows and discount rate. In other words, we would basically apply the time value of money equations and models that we already learned. But at this point, we assumed that we knew the discount rate for the asset investment decision. We also ignored, how one raises the financing. Is it all debt? All equity, or 50% debt, or whatever. Then we moved to the right-hand side of the balance sheet, and we said, hey, why is debt worth 400, and why is equity worth 600? And what two things did we need, again, to value anything? Cash flows and a discount rate. Except for now, we assumed that we knew what the discount rate were for financial securities. And we're ignoring the left-hand side of the balance sheet. In other words, what we were spending our money on. So then we moved to the right-hand side of the balance sheet, and we said, well, hey, what should the discount rate be for financial securities? And what was the primary reason, this was in Lecture 5, what was the primary reason that we even cared about this guy? Well, the primary reason is basically what we're about to do today, and that is that you cannot understand the discount rate for the asset investment decision unless you have an understanding of the discount rate for financial securities. Why is that? Well, as we'll find out today, the discount rate for the asset investment decision is highly related to the discount rate for financial securities. And so that's our goal today, basically to figure out the discount rate for the asset investment decision, which is half of what you need for conducting a bottom line analysis, net present value analysis. And again, what two things did we need to calculate net present value? Cash flows and a discount rate, right? But we'd assumed we were just given the discount rate, so that's what we're going to fix today. And this net present value analysis is sort of bottom line analysis for what kind of decision? The asset investment decision, which is our primary focus and goal in this class. So let's get on to perfect markets. So what do I mean by perfect markets? Is that where All the salaries neatly arranged and everything's just in order, or what? Well, it's definitional, right? This is not understanding because it's a definition. So you memorize definitions, you understand concepts and so forth. And basically, perfect markets means no taxes, no information asymmetries, no transaction costs. What do I mean by information asymmetry? Well, does the CEO of Apple know more about Apple than, say, I do or the rest of the public does? He does, right? And so information asymmetry literally means with a means without in Latin, so without symmetry. So information asymmetry means exactly that, that in this instance, or in that example, we know less about Apple than Apple does. So perfect markets, basically, all of this stuff is obviously unrealistic. So with that in mind, let me give you the remaining of the agenda, and we're going to assume perfect markets. We're going to assume this fantasy land where there are no taxes and no information asymmetries and no transaction costs, etc. And we're going to begin by saying, well, hey, in this fantasy land, what should the discount rate be for a brand new firm? So didn't exist before. And then we'll continue in this fantasy land and we'll say, well, what should the discount rate be for an asset investment decision for a firm that already exists, but it's going to have an additional investment? For example, maybe Intel. Intel already exists, right? But maybe they decide to spend money to invest in a new generation of a microchip. So that would be an example of a asset investment decision, or what should the discount rate be for the new microchip when the firm already exists. So let me ask you this. These perfect market assumptions, no taxes, no transaction costs, no information asymmetry, is that realistic or unrealistic? Well, clearly that's unrealistic, right? I mean, obviously. So why would I waste your time seeing how the world works, if you will? What is the discount rate in this totally unrealistic world for a brand new firm and then for a new project with a pre-existing firm? What's the point? Well, basically, I want to see how the world works, or what the discount rates are in this totally unrealistic world. And it's for simplicity purposes. But then what we'll do is we'll throw in real world criteria. So in other words, then we'll move to imperfect markets. And of those three conditions, no taxes, no transaction costs, no information asymmetries, the only thing that we're going to basically throw back in is taxes. So let me ask you this. Why wouldn't we try to account for information asymmetries? Well, basically, how would you quantify that? And if you did quantify it, would you probably have to make a ton of assumptions? And at some point, when you have to make a ton of assumptions, what happens to the quality of the analysis that you're working with? If you're trying to force something to being quantified as opposed to keeping it qualitative, does it enhance it or dilute it? It dilutes it, right? So basically, the reason we don't try to quantify information asymmetries is because you'd probably end up with sort of garbage in, garbage out type of analysis. Some things are just better left qualitative. Well, what about transaction costs? Could you quantify transaction costs? You could, right? I mean, that's something that's easily quantifiable. However, how significant are transaction costs, at least relative to information asymmetry? So, for example, imagine that I buy $100,000 worth of IBM on E-Trade. Well, how much would I pay in commission? And is that a type of transaction cost? It is, right? So how much would I pay in commission, you think? Maybe $7? So therefore, at least relative to taxes, significant or insignificant? It's just not significant. Now, like I said, it's easily quantifiable and it is taught sometimes and so on and so forth, but basically in the real world, what typically gets adjusted is taxes. And so that's what we're going to do. And by the way, you could either make the adjustment for taxes with the discount rate. So in other words, put the discount rate on a before tax or an after tax basis. On an after tax basis. Or you could make the adjustment in the cash flows. Right? Because remember, with the net present value, what two pieces of information do you need? Well, you need cash flows and a discount rate. So you could either adjust for taxes with cash flows, or you could adjust for taxes with a discount rate. And what we'll do is what is most common, and that is adjust it in the discount rate. So let us begin. Here we have a brand new firm. Maybe this is my lemonade stand or whatever. And so let's say this brand new firm decides to raise money through equity, and of course they spend it on, say, my lemonade stand or whatever. Okay? So here's my question. How are the equity holders, how will they decide what his or her required rate of return is? I mean, will the equity holders require any kind of return? Will they say, hey, take this money for free? They won't, right? They'll require a return, right? So what would they look at? Well, you're probably going to say the risk of the equity, right? Well, that's true, but what would the risk of the equity depend upon? Okay, well, if you're not sure about that, let me ask you this. So suppose I came up to you and I said, hey, will you lend me some money? And you say, well, sure, okay, yeah, no problem. Well, you might say no, but imagine you said, sure, I'll lend you some money. And so you lend me $1,000. Now, are you going to do that for free? Or are you going to charge me an interest rate? Well, presumably you charge me an interest rate, right? So suppose I told you, well, I'm going to take that money to Vegas. Would you charge me a high interest rate or a low interest rate? Well, presumably you'd charge me a high interest rate. Suppose I told you, well, I'm going to invest in a T-bill. Would you charge me a high or low interest rate? Well, presumably a low interest rate, right? So in other words, when it comes to the required rate of return of the equity holder or an investor, then does it matter to them what you're doing with the money? It does, right? They'll basically say, hey, what are you doing with my money? How risky is it? And if the risk is high, then will they require a higher rate of return or a lower rate of return? A higher rate of return, right? Just like when I said, hey, I'm going to take your money to Vegas, were you going to charge me a higher or lower interest rate? A higher interest rate. By the way, speaking of the terms required rate of return, okay, well, what's another name for required rate of return of debt? Interest rate. Okay, so in other words, an interest rate is like a required rate of return, except in that instance it's for the debt holder. In any case, the equity holders, they'll say, hey, what do you do with my money? And the higher the risk of whatever is done with the money, then the higher their required rate of return. So let me ask you this, okay? If in the end the equity holder says, all right, hey, what are you doing with my money? And all right, I'm going to assess that my required rate of return and therefore my discount rate for the equity is, say, 12%. Well, if the overall required rate of return on this side of the balance sheet is 12%, then what must it be on this side? I mean, does the overall risk on this side balance with the overall risk on the other side? It does, right? So if the overall discount rate or required rate of return on this side is 12%, then what is the required rate of return on the other side? In other words, the discount rate for the asset investment decision. Well, it's also 12%. So in other words, if you did an MPV analysis where you spent $1,000 today, and of course there would be expected cash flows, and hopefully the firm has a competitive edge where maybe it spends $1,000 today and one period later expects to get maybe $1,500. But the discount rate that's applied to that risk is only 12%. So would that be positive or negative MPV? It'd be positive, right? So for example, with the example I just gave, I'll just draw a timeline really quickly. Give me a second. So minus 1,000 at time 0, plus say, I don't know, say 1,500. Okay, so imagine that we've got minus 1,000, that's what they spend at time 0, because this company has a competitive edge, maybe this is a lemonade stand or whatever, they expect to get 1,500 in one period and that's the end of the project. Well, if the market's saying, hey, the riskiness inherent of what you do with my money has a discount rate of 12%, then the MPV would look something like this. Minus 1,000 plus 1,500 over 1 plus 0.12. Okay, minus 1,000 plus 1,500 over 1 plus 0.12. And if you did that in your calculator, would you get a number bigger or smaller than 0? Bigger than 0, right? And so that would be positive net present value. So in any case, what we have here, I told you earlier on that the discount rate for financial securities was highly related or completely unrelated to the discount rate for the asset investment decision. I told you it's highly related, right? Well, here's an example where it's identical. Well, let's make things a little bit more complicated. Okay, so suppose we have now a different firm, so I've made up different numbers just to emphasize it. It's still a brand new firm. We're still in perfect market fantasy land, if you will. And but in this case, instead of just equity, now we have debt and equity. So we've decided on $40 in debt and $60 in equity to spend it on something else. Maybe this is my strawberry stand. How's that? Okay. So here we have the debt holder. Now will the debt holder say, hey, I'll lend you money for free? Or will they require a return? They'll require a return, right? There's a required rate of return of debt. Which again, what's another name in the English language for required rate of return of debt? Interest, right? So what do you think the debt holder is going to look at? When they figure out, hey, our required rate of return of debt is, I'll make something else, say 10%. What are they going to look at to make that assessment? Well, they're going to say, hey, or let me put it this way, what did the equity holder look at in the previous example? Well, the equity holder in the previous example say, hey, what are you doing with my money? Well, does the debt holder have a similar interest here? They do, right? So basically, they'll say, hey, what are you doing with my money? And if it's high risk, will they require higher or lower return? They'll require a higher return. Okay, let's look at the equity holder. What are they going to look at? Okay, so these guys. Will they give their money for free or will they require a return also? They'll also require a return, right? So what will they look at? Well, do they care about what you're spending their money on? They do, right? So they too will look at the risk of the asset. And the higher that risk, will they require a higher return or a lower return? A higher return. Now, will the equity holders, will they consider anything else? Is there anything that you see on this balance sheet, which represents the firm, that the equity holders might care about. Well, what about these guys right here? What about the debt holders? If there's a lot of debt holders, then does that make it ceteris paribus, which means all else being equal, does that make it more risky or less risky if you're an equity holder? Well, let's think about this. Imagine this is my strawberry stand. Well, if I invest in a strawberry stand, what am I hoping will happen? Well, I'm hoping I'll sell strawberries, right? So these assets, over the course of the next year or period or whatever it is, they're going to produce sales, but then I have to subtract costs, and I have to pay wages, and so on and so forth, right? And because I have debt, do I also need to subtract interest? I do, right? Because I'll owe interest to the debt holders. And I'll subtract taxes, and when everybody has been paid, the government's been paid their taxes, and the debt holders have been paid their interest, and workers have been paid their wages, and suppliers have been paid, whatever it is they get paid for, etc., etc. When everybody gets paid, who is the very last entity to get any money that happens to be left over, if there is any left over? And that's the equity holders, right? So here's my question for you. The more debt holders there are, relative to the number of equity holders, then does that make it more risky or less risky for the equity holders? Makes it more risky, right? Because who gets paid first? The debt holders. So when the equity holders are thinking about the required rate of returns, not only do they say, hey, what are you doing with my money? But they're also thinking, well, hey, how many of these guys get paid before us? How many debt holders are there? Or if you want me to be a little more exact about it, what's the dollar perspective of the debt holders? So let's say that the equity holders, they go through this process and they say, all right, what are you doing with my money? And how many get paid first? And so they come up with the required rate of return of, say, 20%. And let's say the debt holders say, all right, well, what are you doing with my money? And they come up with a required rate of return of 10%. Okay? So before it was easy. We only had one number on the right-hand side reflecting the discount rate on the left-hand side. But now we've got two numbers. So how are we going to decide what the discount rate is for the asset investment decision? Well, with this information, can we figure out, if you will, what the overall discount rate is on this side? We can, right? How would we calculate that? Well, we could use a weighted average, right? And so is it fair to say that the overall discount rate on this side, which is reflected by a weighted average, is going to be or mirror the overall discount rate on that side? It is, right? And so essentially what we have is that therefore the discount rate for the asset investment decision is essentially the amount of debt we have times the required rate of return of debt, and the same with equity. So in this example, we have 40% debt on this side with a required rate of return of 10%. So there's that 0.4 and the 0.1. And we have 60% equity on that side, okay, with a required rate of return of 20%. So a weighted average of the discount rate for the asset investment decision would be 16%. And so therefore, what should the discount rate be for this if you're going to do an NPV on this side? Basically 16%. So let me ask you this. Let's say that this is the exact same firm, And we've already gone through this process, and the debt holders said, all right, 10%, and equity holders said 20%, and so therefore the discount rate for this asset was 16%. And I know that, well, I'll put it this way. Does risk change on a second-by-second basis, or is it static? It changes, right? But just hypothetically, imagine that just for 1 second the risk did not change. So all of this has already been established. The discount rate for this asset investment decision is 16%. But then, 1 second later, say management changes their minds, and they say, you know what? Let's not borrow any money. Let's just have it all equity. So here's my question. What should the discount rate be for the asset investment decision? Think about it. It's tricky. Well, one thing you might be thinking is, all right, well, hey, here's a formula, no problem. Now we have, let's see, what percentage equity? 100% equity, so I'd put what number in right there? The number 1, right? And then what number would I put here? Well, you might be tempted to put a 20% here, and then you might be tempted to conclude that therefore the discount rate for the asset investment decision is 20%. Because after all, what you're used to is all of this side in a formula is what determines that side. And that's the normal way one uses a formula, correct? However, let's think about it. Before, in this situation, when the equity holders had a discount rate of 20%, number one, did they look at the risk of what you're doing with my money? They did, right? And what else did they look at? Well, how many folks get paid before me? So if we move to this situation right now, are they still looking at, hey, what are you doing with my money? They are, right? And they're still looking at how many are getting paid before me? They do, right? But what's changed? Is there anyone getting paid before them, at least from a debt holder perspective? There's not, right? And so, ceteris paribus, does that make it more risky or less risky for the equity holders if nobody else, if nobody's getting paid before them, at least from a debt perspective? Makes it less risky, right? So this number 20%, would it stay that high, or would it be something less than that? Well, presumably it'd be something less than that, right? And so the question is, well, how much less? Well, if 1 second before, the discount rate that applied to that reflected the riskiness inherent in this asset investment was 16%, and if we assume that 1 second later it was still 16%, then if the overall risk on this side, or discount rate reflected, is 16%, then the overall risk on this side must also be what? 16%. In which case this 20, we know it's going to be something less than that. It will have gone down to what? It will have gone down to 16%. And the only way I know that is because 1 second before, basically the market on this side had already assessed that the riskiness inherent in this asset would be reflected by a discount rate of 16%. So what that means is that when it comes to the discount rate for the asset investment decision, does it depend upon how a firm happens to structure their capital, or does it depend upon the use to which funds are put? Well, basically, it depends upon the use to which funds are put. So in other words, what's going on is that, yes, management decides, well, all right, I wonder how much debt we'll have, and I wonder how much equity we'll have. But once that has happened, what is determining these two guys, the RD and the RE? What's the primary driver of that? Well, it's what you do with my money, which makes sense, right? I mean, when I originally came to you and said, will you lend me some money, what did you want to know? What am I doing with your money? If I'm investing in high risk, you require a high return. So it is this guy that is the driver of these two RDs and REs. Yes, management decides the capital structure, but the market assesses the risk inherent in the asset. And so these guys, are developed based upon what you do with the money, which makes a lot of sense. And so even though with a formula you're used to using the right-hand side and that determines the left-hand side, in real life, given that management decides how much debt and how much equity, in real life it's the left-hand side, in other words what you're doing with the money, that determines these required returns. However, from a pragmatic perspective, we are forced to use data that's provided in the marketplace on the right-hand side to infer the riskiness of the asset. I mean, why not just figure out the riskiness of the asset directly? Why even bother looking at this right-hand side information to infer the riskiness on the left-hand side? What do you think? Well, is data available? Could I look at, say, I don't know, the Apple's latest iPhone and say, all right, well, I determined the discount rate or the riskiness inherent in that to be X%. Could I look at it in a direct sense and somehow calculate that? I couldn't, right? But on the other hand, in the marketplace, do we have information where we can figure out required rate of returns of equity and required rate of returns of debt because we know what stock prices are and bond prices and so on and so forth? We can, right? In other words, the reason that we use the right-hand side of the balance sheet, i.e. the investment side, the stock market and the bond market and the financial markets, the reason we use the data on this side to infer the risk of the asset on the left-hand side is because the data is available. It's available in the financial markets, where it's not directly available on the left-hand side. Okay, so we are still in perfect market fantasy land, and now we're looking at pre-existing companies that already exist, and they're making an incremental or additional asset investment decision. Okay? So suppose here we have the pre-existing assets. This is the firm, whatever it is. Maybe it's Intel or whatever. And let's say that this company has $400 in debt, and the debt holders say, hey, what are you doing with my money? And they require a return of 10%. The equity holders say, hey, what are you doing with my money? And how many get paid before me? And they require a return of, say, 20%. And by the way, is this a snapshot? Do these numbers change on a second-by-second basis? They do, right? Just like in the same way stock prices move by second-by-second basis, these are changing on a second-by-second basis. By the way, to get required rate of return of debt, if it were publicly traded, then how could we get this guy in real life? What information would we need? Well, let me show you. Suppose, for example, this is a bond, and let's say that it's trading right now today for, say, $1,000. So in other words, if you bought it today, you'd have to pay $1,000 for it. And suppose that it matures in 1 year, and when it matures in 1 year, you expect to get back principal of 1,000 plus 100. With that information, does there exist a discount rate where 1,000 would grow into 1,100? It does, right? That would be 10%. In this example, the yield to maturity. And so this would be the discount rate or the required rate of return for the debt holder for this particular bond. What about with equity? We see a 20% number there for the required rate of return of equity. Where do we get that information in real life? Well, what model did we develop in Lecture 5 of this series, where we were able to use market data to infer the required rate of return for the equity holder? That was the CAPM model, right? Capital Asset Pricing Model. And there are other models that link risk with return, but if you want, go back and take a look at that. But in any case, getting back to this, debt holders say, hey, what are you doing with my money? We require 10%. Equity holders say, hey, what are you doing with my money? How many get paid before me? And we require 20%. So with that information, could I figure out the discount rate of the firm as a whole as it exists right now? I could, right? As we already saw, a weighted average, which in this example would come to 16%. Now let's say this company decides, hey, I want to make an additional asset investment decision costing $100. Okay? So there's my new asset. And suppose that they decide to raise money for the new asset with, say, $40 in debt and $40 in equity, and $60 in equity. So here's my question for you. What should the discount rate be for the new asset? Well, if you said 16%, then what would you be assuming? Well, what was the riskiness reflected in the existing firm? 16%, right? So if you said this new asset, the discount rate was also 16%, would you basically be making an assumption that the riskiness inherent in the project is the same as the firm? You would, right? You'd basically be assuming that. And often that's not a bad assumption. For example, if Intel invested in a new microchip, and to my knowledge, I think that's all that Intel does. I think that the primary focus is on the development of microchips. Maybe I'm wrong, but let's just assume that. Then would that be a reasonable assumption? It would, right? But what if IBM were investing in a fish farm? Is fish farm risk the same as IBM risk? It isn't, right? So if this were IBM and this new asset was the fish farm, would assuming the discount rate for this fish farm 16%, would that be a good or a bad assumption? That'd be a bad assumption, right? And when it came to doing an NPV analysis, if you truly wanted to know whether the fish farm was expected to create or destroy value, would you be wanting to work with IBM risk or fish farm risk? Well, you'd want fish farm risk, right? Because that's what you're analyzing, okay, for the discount rate. Now, of course, in IBM's case, since they don't know how to operate a fish farm, if we go back to this example, okay, if this is the fish farm, and IBM doesn't know how to operate a fish farm, well, IBM probably wouldn't have something like that. Maybe because they're really bad, maybe they spend 1,000 and they only expect to get 800, right? And so, but the discount rate would still be reflective of fish farm risk. And so therefore, when you make a new asset investment decision, then what is relevant? Is it the risk of the existing firm, or is it the risk of whatever that new asset is? It's the risk of that new asset, which again may or may not be the same as the firm. But if this was IBM investing in a fish farm, obviously that would be a bad assumption. So how would you get the discount rate for a fish farm? Well, guess what? You'd have to go look at all those other publicly traded fish farm companies and use them, use market information, again on the right hand side, Okay, so the bond markets and the stock markets and so on and so forth, to infer what the risk is on the left-hand side. So in other words, you could not use IBM information to infer fish farm risk. You would have to use fish farm information that the marketplace is analyzing through their stock prices and bond prices, etc., to infer fish farm risk. So let's say they decide, you know what, instead of 60-40, let's make it 10 and 90. Now what would be the discount rate for the new asset? Well, does the 10 and the 90 matter relative to the 40 and the 60? It doesn't, right? As we saw earlier, the discount rate that applies to the asset investment decision, does it depend upon the source of funds or the use to which funds are put? Depends on the use to which funds are put, right? So in this example, if it were true that the new asset had similar risk to the existing firm, well then it would still be 16%. Now, some companies, what they'll do is they'll say, all right, well, we'll have a policy where if the internal rate of return of the project exceeds the firm's hurdle rate, then we'll do it. So there's quite a number of terms in there. Well, first of all, what's an internal rate of return? Do you remember that was in lecture 3 of this series? Well, it's basically a break-even discount rate such that the net present value equals what? 0, right? Let me show you what I mean. Okay, so let's say we have an asset investment decision. So we'll make that 1,000. And let's say that, I'll show you these numbers in just a second. Okay, so here we have an asset investment decision of 1,000. So you spend money today, and let's say it's hoped that, or expected that 1,200 would be reaped from this asset investment decision, and then that's the end of the project. Well, what kind of discount rate would give me a net present value of 0? It would be 20%, right? I'll show you real quick. Minus 1,000 plus 1,200 over 1 plus 0.2 equals 0. Okay, minus 1,000 plus 1,200 over 1 plus 0.2 is 0. So this 0.2, that's basically the internal rate of return. So essentially, what will happen is some companies will say, all right, well, hey, the internal rate of return of that is 20%. But suppose the market applies a discount rate of, say, 15%. Okay, so in other words, the internal rate of return is 20% on this, but let's say the market says, hey, what are you doing with my money? And they apply a required rate of return or discount rate of 15%. So would that be happy face or sad face? That'd be happy face, right? Because this 15%, or this required rate of return, is that essentially what it's, at least given the assumption so far, what it's costing the firm to raise this money? It is, right? But they're expecting to reap more cash flows than what it's costing them to raise the money, which is happy face. That'd be like positive NPV. So what some companies do is, well, they have this 15%, which represents, they call it a hurdle rate. It represents the discount rate for the firm as a whole. But then they'll take a specific project and they'll say, all right, well, if the internal rate of return is greater than this hurdle rate, then we'll do it. But when they do that, when they make that kind of, or have that sort of policy, what are they assuming? Or are they assuming anything about the risk of the new asset relative to the risk of the existing firm? This whole policy basically makes that assumption. I mean, you could have a multinational conglomerate, for example, that makes defense equipment and machinery that makes orange juice and agricultural chemicals and so on and so forth. It's a whole hodgepodge of risks. And the firm would have one hurdle rate because the market is looking at this conglomerate as a whole, which is what the stock price is based on and their bond prices. So there's still one number, but it reflects this whole hodgepodge of risks. And so if this firm then said, you know what, we're going to look at building this new mine in North Dakota. Well, would the risk of that new mine in North Dakota, would it be the same, or would it likely be different from that whole mixture of all those other risks? Probably be different, right? So if you had a policy, or if this firm had a policy, hey, if our internal rate of return for this mine in North Dakota exceeds the hurdle rate for the firm as a whole, then you could have some flawed decision making going on. Let me show you what I mean. Okay, so let's say here's risk, which we've now seen from lecture number 5, that beta is the appropriate way of measuring this risk. And so let's say that the higher the risk of the project, the higher the lower the required return. The higher the required return, right? Now imagine this 10% here is the firm's hurdle rate. So here we have project A, and so the project A is higher or lower than the hurdle rate? It's higher, right? Their internal rate of return is basically going to be higher. So per the rule, would they do the project? Would they say, yes, full speed ahead, let's do it? They would, right? The internal rate of return is basically greater than 10%. However, would A be positive or negative NPV? Well, there's the internal rate of return right there. But given this risk level right here, just to break even, do they require more or less? They require more, right? And so basically, that gap would be the equivalent of a negative net present value. So in other words, they would have said, yes, we'll do it because it's higher than the hurdle rate, but given the risk of A, just to break even, you would need an even higher return. And so therefore this would be negative NPV. Let me show you another example. And so we got project B. Is project B higher or lower than the hurdle rate? It's lower, right? So would they do it or not do it? They wouldn't, right? On the other hand, would B be positive or negative net present value? Well, it would be positive. Why? Because given this level of risk, just to break even, this is what they require. But the internal rate of return means their expected cash flows are going to be even higher than what the market is requiring given their level of risk. So in other words, the firm would be saying yes or no to a positive NPV project. They would be saying no. By the way, is assuming firm risk as new project risk, is that necessarily bad? No, it's not. I mean, often it's true, right? Intel investing in a new microchip, it's probably a very good assumption. But you know what? Sometimes companies make this assumption even when it's not true, because sometimes it can be very, very tricky figuring out what the discount rate is for an asset investment decision. So for example, if you ever did the Boeing 7E7 case, that's a Darden case, that's about, hey, what should the discount rate be for the Dreamliner? Well, in that case, can you use data provided by the market to directly tell you about the risk of commercial aircraft by Boeing? And to answer the question, Boeing has part of their business is defense and part of their business is commercial aircraft. Well, if you believe those risks are different, when you look at Boeing's stock price and what their bonds are trading for and so on and so forth, are they going to reflect a mixture of those risks or just commercial aircraft risk? A mixture, right? And so it's situations like that where figuring out the discount rate for a new asset can just be incredibly tricky. So what do some companies do? They basically throw up their arms and say, all right, we're just going to have this simplifying assumption. If the internal rate of return of the project is greater than our hurdle rate, then we're just going to go ahead and do it. It's a simplifying assumption. All right, so let's move to imperfect markets. And as I mentioned earlier, all we're going to do is taxes. I mean, we could adjust the cash flows, but we're going to focus on incorporating taxes and adjusting the discount rate when we incorporate taxes. That's the most common thing to do. So, let me ask you this. When a company raised money with equity, did the equity holders say, hey, yeah, here, take our money for free? Or did they require a return? They required a return, right? And when any investor requires a return, is that a cost to the firm? It is, right? So basically, when a company issues equity and the equity holders require a return, then that is basically a cost to the firm. Now, it's easier to picture that with debt, right? Because with debt, you can imagine in your head that cash is flowing, from the firm, and they're paying interest, right? But what is a way that an equity holder can get their required return? Well, if they require a higher return, are they only going to be willing to buy the stock price at a higher price or a lower price? At a lower price, right? I mean, that's why, for example, when you have a risk increasing event happening. So, for example, when the planes flew into the towers, was that a risk increasing event? It was, right? I'm not trying to be tragic. That's just an example of a risk increasing event. And so, did the equity holders, did they require a higher return or a lower return with that risk increasing event? They required a higher return, right? And so to bribe them, if in a sense, into being willing to say, buy a stock, what would have to happen to the price of the stock to incentivize them to buy it? It would have to drop. That's why when you have a risk increasing event, stock prices drop. And the reason stock prices drop is because the equity holders say, hey, we require a higher return, which means we're only going to be willing to buy in at a much lower price. So in any case, the equity holders will require a return, and that's like a cost of raising that capital to the firm. Now what about debt? Did the debt holders also require a return? They did, right? We call it the required rate of return of debt. And in perfect market land, when we put it all together, the cost of capital to the firm was basically a weighted average of these two required returns. But now let's add in corporate taxes. When it comes to debt, in a sense, is the government picking up part of the tab for the cost of debt? They are, right? And why is that? Well, because interest payments are tax deductible. So let me show you an example. Let's say a firm makes a $100 interest payment and the tax rate is 30%. So there's their interest payment. We haven't talked about any tax impacts yet, but because of that $100 interest payment, does that mean they'll pay more taxes or fewer taxes? Fewer taxes, right? How much less in taxes if the tax rate is 30%? $30, right? So in other words, they'll save taxes of $30. Let me put it a different way. Suppose somehow a firm had $100 of additional taxable income and the tax rate was 30%. Well, how much extra would they pay in taxes? $30. But this is the other way around. This is $100 less of taxable income. So therefore they pay how much less in taxes? $30. And so therefore the after-tax cost of interest would be the $70. So here's my question. How can I go straight, what would I take this 100 and multiply it by to go straight from the 100 to the 70? Well, you could multiply it by 0.7, right? But 0.7 is that also 1 minus the tax rate? 1 minus 0.3? It is, right? So in other words, to get an after-tax cost of interest, I take my before-tax number and I multiply it by 1 minus the tax rate. Or if I use words there, the after-tax cost of interest is before-tax cost of interest times 1 minus the tax rate. So here's my question. This guy right here, is that a before-tax cost or after-tax cost? It's before tax, right? So what would I do to that guy to turn it into an after-tax cost of debt? Well, what did I do on the previous slide? What did I multiply that $100 by? I multiplied it by 1 minus the tax rate, right? Well, could I do the same thing here? I could, right? And so basically, to adjust the discount rate for the asset investment decision and put it on an after-tax basis, all I do is just multiply this required rate of return of debt by 1 minus the tax rate. And so there we've achieved our goal of figuring out the discount rate for the asset investment decision. And by the way, this is also known as the weighted average cost of capital. So now instead of memorizing, all right, well that's interesting, hopefully you have a much better perspective of why it is that this reflects the discount rate for the asset investment decision. And only because you have that perspective, when it comes to applying it in real life, as you work with this stuff, when you apply it in cases or real life decisions or whatever, you're going to have a much better opportunity or chance of using reasonable judgment when you bridge theory with practice. So this is James Tompkins, and I hope this was a good learning experience for you. Thank you.